Silver is heading into a dangerous Monday. Right now, it is sitting just beneath a level that has already rejected it twice, a level where everything could change in a matter of hours, because on the other side of the world, one of the most critical oil corridors on the planet has gone almost silent. Ships are not moving, tensions are rising by the hour, and what happens next could either send silver tearing through resistance, or trigger the exact chain reaction that sends it crashing back down. There's one number the market is not talking about enough. One number that could decide everything by Monday's close. And by the end of this video, you will understand exactly what it is, and why almost no one is prepared for it. Welcome to Currency Arc Insight, the channel built for those who read markets before the headlines catch up. If this is your first time here, hit subscribe now so you never miss a warning like this one again. Drop a comment and let us know which city you're watching from tonight. Silver is trading right around $65 an ounce, and it is sitting in one of the most delicate positions it has occupied in months. Behind this number lies a market that has fought hard to recover, only to arrive at a wall it has already failed to break through twice before. Analysts watching the metal closely describe this zone between $65 and $66 as the line that will decide the next major chapter for silver investors. To understand why this level matters so much, it helps to look back at where silver has been. Earlier this month, the metal fell to a low near $57, a drop that shook confidence among traders who had expected a smoother climb. From that low, silver staged a strong recovery, climbing steadily and reclaiming much of the ground it had lost. That recovery brought it back to the same resistance band it had struggled with before. Now, heading into a new trading week, the metal finds itself parked just beneath that ceiling, waiting for a signal strong enough to push it through. That signal may come from a place far from any trading floor. Thousands of miles away, one of the most important shipping routes on the planet has slowed to a crawl. The Strait of Hormuz, a narrow passage that carries a significant share of the world's oil, has seen its usual traffic nearly disappear. Tankers that would normally move through the strait without incident are now sitting still, and the reason is not a technical failure or storm. It is tension. Rising hostility between the United States and Iran has turned this waterway into a flashpoint, and the uncertainty surrounding it is beginning to ripple outward into global markets, silver included. This is not the first time a geopolitical standoff has influenced the price of precious metals. But the timing here is unusually significant. Silver is not simply drifting near resistance during a quiet news cycle. It is approaching a breaking point at the exact moment the world is watching a potential energy crisis unfold in real time. That combination, a technical level under pressure and a geopolitical shock building in the background, is what makes this particular Monday different from an ordinary trading day. Business leaders and serious investors tend to pay close attention to moments like this because they understand that markets rarely move in straight lines. Instead, they tend to coil, building pressure quietly before releasing it suddenly. Silver's current position looks very much like one of those coiled moments. The metal has not broken down, and it has not broken out. It is holding, testing the patience of everyone watching it, while forces outside the metals market itself continue to build. What makes this setup worth paying close attention to is not just the price level itself, but what that price level represents. A breakout above $65 to $66 would suggest that fear, uncertainty, and a weakening dollar are beginning to outweigh confidence in traditional assets. A failure to break through, on the other hand, would suggest that the market still believes calm will return before real economic damage is done. Neither outcome is guaranteed, and that uncertainty is precisely why this moment deserves careful analysis rather than casual observation. As the new trading week approaches, all eyes are turning toward two things happening at once: a technical resistance level that has already proven difficult to crack, and a geopolitical situation that is evolving by the hour. Together, they are setting the stage for what could become one of the more consequential trading sessions silver has seen in recent memory. The next part of this analysis will examine exactly how these two forces interact, and why the very thing that could push silver higher may also be the thing that eventually works against it. To understand what could happen to silver on Monday, it helps to picture two roads running in opposite directions from the exact same starting point. Both roads begin with the same event, continued disruption at the Strait of Hormuz, but from there, they lead to completely different destinations. And right now, nobody can say with certainty which road the market will end up taking. The first road is the one that would please silver investors. If tensions in the Middle East continue to rise, fear tends to spread quickly through global markets. Investors who feel uncertain about the future often turn away from riskier assets and look for something that has held value for centuries. Silver, alongside gold, has traditionally played that role. At the same time, rising fear usually puts pressure on the US dollar. When the dollar weakens, silver becomes cheaper for buyers using other currencies, which can pull in fresh demand from overseas. On top of that, growing instability tends to make central bankers more cautious about raising interest rates, since higher rates can slow down an already nervous economy. Lower expectations for a rate hike are historically good news for metals like silver, because silver does not pay any interest or dividend, so it becomes more attractive when the reward for holding cash or bonds goes down. If all three of these forces line up together, fear, a weaker dollar, and reduced rate hike expectations, many analysts believe silver could finally push through the resistance it has been fighting for weeks. But there's a second road, and it leads somewhere far less favorable. The same tension in the Strait of Hormuz that could scare investors into buying silver is also capable of driving oil prices sharply higher. This strait is one of the busiest oil transport routes on Earth, and any serious disruption there tends to send energy prices climbing almost immediately. Higher oil prices do not stay isolated. They move through the economy quickly, raising the cost of transportation, manufacturing, and everyday goods. That is how inflation fears get reignited. And once inflation becomes a concern again, the entire conversation around interest rates can shift overnight. Central banks that were expected to hold steady or even cut rates may suddenly be forced to consider raising them instead in order to keep prices under control. Higher interest rates are historically one of the biggest headwinds for silver, since they make holding non-yielding assets far less appealing compared to interest-bearing alternatives. This is what makes the current setup so unusual. In most situations, a single catalyst tends to point in one clear direction. But here, the same event, continued conflict near the Strait of Hormuz, has the power to both help and hurt silver at the same time, depending on how far it goes and how the market chooses to interpret it. A moderate escalation might be enough to spark fear without pushing oil prices to dangerous levels, giving silver the room it needs to break higher. A more severe escalation, however, could tip the balance the other way, turning today's bullish catalyst into tomorrow's biggest obstacle. This is why serious market participants are watching not just silver's price, but the broader chain of events surrounding it. The relationship between oil, inflation expectations, and interest rate policy has always been closely tied to the fate of precious metals, but rarely has that relationship been on such clear display heading into a single trading session. Every headline coming out of the Middle East over the weekend has the potential to shift the balance of power between these two competing forces. As Monday approaches, the central question is no longer simply whether silver will break through resistance. The real question is which version of this catalyst will win out, the one that lifts silver higher or the one that quietly turns against it. The next part of this analysis will look back at history to see what past episodes like this one can reveal about which outcome tends to be more likely. History rarely repeats itself in exact detail, but it often rhymes closely enough to offer useful guidance. When trying to understand how silver might behave once the current standoff at the Strait of Hormuz reaches its next stage, it becomes worthwhile to look back at earlier moments when energy disruptions and precious metals collided in similar ways. There have been several occasions in recent decades where sudden shocks to global oil supply routes sent an immediate wave of fear through financial markets. In many of those cases, gold and silver spiked quickly in the first hours or days following the disruption. Investors, uncertain about what might happen next, rushed toward assets they trusted to hold value regardless of political turmoil. On the surface, these moments often looked like the beginning of a lasting rally, but a closer look at what happened afterward tells a more complicated story. In several of these past episodes, once it became clear that oil supply disruptions were temporary or contained, the initial fear-driven rally in metals began to fade. Markets recalibrated quickly once traders realized that global supply chains were adjusting, alternative routes were being used, or diplomatic pressure was easing tensions faster than expected. When that happened, the same fear that had pushed silver and gold higher reversed just as fast, and prices settled back toward levels closer to where they started. These were the false breakouts, moments that looked convincing in the moment but ultimately failed to hold. By contrast, there were other periods where the disruption proved far more serious and long-lasting. In those cases, oil prices did not simply spike and settle, they remained elevated for an extended stretch of time. That sustained pressure fed directly into inflation data, which in turn forced central banks to respond with real policy changes rather than simply adjusting expectations. When that deeper economic shift occurred, precious metals tended to hold their gains, and in some cases, continued climbing well beyond their initial spike. These were the genuine breakouts, the ones supported not just by fear, but by a real and lasting change in the economic backdrop. The challenge for anyone analyzing the current situation is figuring out, in real time, which type of event this is likely to become. Fortunately, history does offer a few reliable signals that have historically helped separate the two outcomes. One of the clearest signals has always been the behavior of the US dollar index. In cases where a rally in metals proved temporary, the dollar tended to recover fairly quickly once initial panic subsided. In cases where the rally was more durable, the dollar continued to weaken over an extended period, reflecting a deeper loss of confidence rather than a short-lived reaction. A second reliable signal has been the movement of long-term government bond yields. When yields dropped sharply and stayed lower for weeks rather than days, It often reflected genuine concern about economic slowdown, which historically supported a longer-lasting move higher in silver and gold. When yields dipped only briefly before bouncing back, it usually meant the market viewed the disruption as short-term noise rather than a structural shift. Finally, the price of oil itself has offered one of the most direct clues. Historically, when oil prices climbed but stayed below certain critical thresholds, the inflationary impact remained manageable, and metals were able to hold their gains without triggering a hawkish shift from central banks. When oil pushed past those thresholds and stayed there, inflation fears intensified quickly, often forcing a policy response that eventually worked against silver rather than for it. These three signals, the dollar index, long-term bond yields, and the price of oil, have historically served as an early warning system for distinguishing a genuine breakout from a temporary spike. As the current standoff at the Strait of Hormuz continues to unfold, these are precisely the indicators serious investors will be watching most closely heading into the new trading week. The next part of this analysis will bring these historical lessons together with the present situation in order to outline exactly what Monday's price action is likely to reveal. Bringing together everything examined so far, three separate threads now converge on the same point in time. Silver is holding just beneath a resistance level it has already failed to clear twice. A critical global oil corridor remains under serious strain, and history has shown that only a specific combination of signals can reveal whether a move like this will hold or collapse. As the new trading week begins, all three of these threads are about to be tested at once. The first thing serious investors will be watching is the US dollar index. Based on the historical pattern discussed earlier, a rally in silver that is genuinely supported by deeper economic concern tends to come alongside a dollar that keeps weakening over time rather than one that snaps back quickly. If the dollar continues sliding through the early part of the week, it would suggest that the market is treating this situation as more than a short-lived scare. If instead the dollar stabilizes or recovers within a day or two, it would be an early sign that any move higher in silver may not have the strength to last. The second signal worth tracking closely is the behavior of long-term government bond yields. A sustained drop in yields, one that continues for more than just a session or two, has historically reflected real concern about slower economic growth ahead. That kind of environment has tended to support silver over an extended period. A yield move that reverses quickly, on the other hand, would suggest that markets view the current tension as contained, reducing the odds of a lasting breakout. The third and perhaps most important signal is oil itself. As explained earlier, there appears to be a threshold beyond which rising oil prices stop being simply a reaction to fear and start becoming a genuine inflation risk. If oil climbs, but remains below that threshold, silver may still find room to move higher without triggering renewed concern about interest rates. If oil pushes decisively past that point and stays elevated, the entire narrative could shift within days, turning today's bullish catalyst into a headwind strong enough to erase recent gains. Taken together, these three indicators form a kind of early warning framework. None of them can predict the future with certainty, but each one has historically offered a meaningful clue about which direction a situation like this is likely to move. For business leaders and serious investors, the value of this framework lies not in trying to guess the outcome in advance, but in knowing exactly what to watch for as events unfold, rather than reacting emotionally to every headline that appears over the weekend. What makes the coming days particularly significant is that this is not simply a routine test of a familiar price level. It is a moment where a purely technical question, whether silver can finally clear long-standing resistance, has become tightly connected to a real-world geopolitical crisis with the potential to reshape inflation expectations and interest rate policy for months to come. Few moments offer such a clear intersection between chart-level analysis and macroeconomic reality. As trading resumes, every piece of news coming out of the Strait of Hormuz, every shift in the dollar, every movement in bond yields, and every tick in the price of oil will carry weight far beyond its immediate headline. Silver sits at the center of all of it, neither confirmed as a breakout nor dismissed as a failure, waiting for the market to decide which version of this story becomes reality. What happens next will not simply determine where silver trades for the rest of the week. It may set the tone for how investors interpret the relationship between geopolitical risk and precious metals for the remainder of the year, making this coming Monday one of the more consequential sessions this market has faced in recent memory.